Hello everyone, welcome back to another video. Today we're going to be talking about something quite important from a strategic perspective for a lot of longer term shareholders, and something that I was talking about with a lot of my colleagues at work. Why do companies buy back shares? And really this discussion can be split into two sides. There's one side that really doesn't care about it. At the end of the day, they're looking to the company to allocate that cash really to the best means possible, and they make the assumption that by reducing the amount of shares outstanding and improving earnings per share and reducing the price to earnings ratio for that respective company, that will benefit them in the short to medium term. And then on the other side, there's the longer term shareholders who view the use of capital, of a company's capital, whether they earned it through operations or raised it through a debt offering. The use of that capital is inefficient when buying back shares, because their argument is that, that cash is not going directly to investors, not to the shareholders, right? And both sides are right in a way. It just depends on how you look at buybacks. So we're going to go and we're kind of understand the mechanics of the buyback and then also understand both sides of the argument. So let's get started. So the key questions for this video: how do stock buybacks work? Are stock buybacks bad for shareholders? And then we're going to be comparing two different capital allocation policies, dividends versus buybacks, and which one is better. And I can already tell you from now, it's all relative. It's all dependent based on the certain situation for that respective company. So let's start off with the first question. How do stock buybacks work? So when a company buys back its own stock, it has two options. One, the company can hold the stock in treasury and reissue it at a later date. Or two, the company can retire the shares to reduce the shares outstanding. Those shares cannot be reissued at a later date, and if they wanted to, reissue shares, they'd have to actually, go and conduct a secondary offering. So the rule overseeing these open market purchases is the SEC Rule 10b, Section 18, and it was instituted in 1982. And an interesting fact is, once this rule was set in place after 1982, the amount of buybacks that were conducted by companies increased significantly. Before 1982, buybacks in corporate America were very uncommon. And the management had to go through several hoops and hurdles, especially with shareholders, to get that approval. Now, with this rule, this allowed the board to authorize the repurchase of company shares following a set guideline. And the key is that shareholder approval is not needed to initiate these buyback programs. So a company's executive can go directly to the board and propose that they buy back X amount of shares by for the next 3 years and reduce the share count by X percentage, and shareholders have no say on that, as long only management is able to vote on that respective issue. So it's really important to have an independent board, but majority of the time that's not the case. So the second option is much more common, as there are many more benefits to retiring stock and reducing shares outstanding. However, if a company does hold its own stock and sells it back to the market at a higher price, that can also generate additional funds. It is, however, a much more uncommon option. So option number 2 is much more common than option number 1. So let's look at an example. Consider ABC Corp. They have a market cap of $320 million with 10 million shares outstanding, trading at $32 a share with a dividend of $1 a share. If the company wants to use 50% of its net income, or $15 million, to retire outstanding shares, how much would be retired, and how does that impact the company? Before we actually look at the numbers, let's just understand, the simple step-by-step. It's very easy. It's just a stock buyback is a corporation. It takes its cash on hand, goes to the stock market, it buys back stock, and then it retires that stock through, certain formal procedures to retire that stock. And then they can either tell the shareholders before or after. It's their discretion, dependent on what management wants to do. And so it's very simple to buy back stock. It's not a complicated process. There are certain strict rules, which we'll talk about, and really it revolves around the SEC ruling, the 10b-18, Section 18 ruling. So let's look at this example. So just displaying the same information once again, we have a current share price of $32. Dividend per share is $1. That gives you a dividend yield of 3.13%. Shares outstanding is 10 million, a market cap, which gives you a market cap of 320 million, and net income is 30 million, or 50% of that net income would be 15 million, right? So now, taking that 15 million, if we were to go into the open market and buy back shares at the current share price, assuming that the current share price stays the same, of $32 a share, we could buy back around 468,750 shares. So if we buy back those shares using $15 million, our new shares outstanding from the original 10 million now declines to 9,531,250 shares. So that's relatively simple to calculate, the post-buyback shares outstanding. It's not that complicated. But let's see how that reduction in the number of shares outstanding impacts the company's financial ratios. So pre-buyback, the company's earnings per share, its EPS, was $3 a share. Earnings per share is you take the net income of the company and you divide by the number of outstanding shares. So you take 30 million divided by 10 million and you get $3 a share. Now, price to earnings is you take the current share price of the company and you divide it by the earnings per share, which in this case is $32 a share, and you divide it by 3 to give you a PE ratio, price to earnings ratio, of 10.67. Right? And the dividend payout based on the current annual net income of 30 million, so the dividend per share is $1 a share and the shares outstanding is 10 million. So the dividend expense is $10 million for that respective year. And $10 million divided by $30 million for net income gives you a dividend payout ratio of 33.33%. So pre-buyback, those are important financial statistics that we want to focus on. Now, post-buyback, the moment that we take that $15 million, reduce our number of shares outstanding to 9,531,250 shares, post-buyback, our EPS increases to 3.15, our price to earnings falls to 10.17, and our dividend payout ratio falls to 31.77%. So why is that? Well, let's look at EPS once again. Earnings per share, right? So you take your earnings and you divide by the number of shares. Now that we're dividing by a smaller number than before, because before we divided net income, 30 million, divided by 10 million. But now we're dividing 30 million divided by 9.531 million. Right? So the end result of that calculation gives us a higher value, a higher EPS ratio, which is good. You want a company that earns more per share, and then from a price to earnings perspective, now we're dividing the $32 per share by a higher value, which gives us a lower value, right? So our price to earnings actually declines. And at the same time, you have to look at the dividend payout. So if the company were to now pay a dividend of $1 per share, with the new shares outstanding, that they pay less. The dividend expense ratio would be significantly less, right? It declined by $468,750. I made the example easy because it's $1 per share, right? And so that means that our dividend payout ratio also declines. And so that's really the core difference between pre and post buyback. That's what changes in a company, right? So our dividend payout ratio has dropped by 1.56%. Our share count, the amount of shares outstanding, fell by 4.69%. Our EPS, our earnings per share, increased by 4.92%. And then interestingly enough, our price to earnings also declined by the same amount as our shares outstanding. And so that's common with any type of buyback. So the amount of shares that outstanding, the fall in those shares outstanding, also reduces the price to earnings ratio by that same amount. So our price to earnings also fell by 4.69%. And so say, for example, you were a shareholder holding 1 million shares of the initial 10 million shares outstanding. Our pre-buyback ownership percentage would be 10%, and our post-buyback ownership percentage would be 10.49%. So essentially, I've tried to fit everything on one slide to show you all of the different changes that can occur to different stakeholders within that organization. For the organization as a whole, the dividend payout ratio it decreases by, in this case, 1.56%. Our share count drops, our EPS increases, our price to earnings drops, and the remaining owners within that business, their ownership percentage also increases. So that entrenches the current ownership. So now, what if we took out an additional $10 million in debt to conduct a $40 million buyback to retire 12.5% of shares outstanding? So we're taking the net income of $30 million, we're taking out an additional $10 million in debt. So our cash plus debt, our buying power is going to be $40 million. So once again, we're taking that $40 million, we're dividing it by 32, and we can buy back about 1.25 million shares, to get a new shares outstanding of 8.75 million. So that reduces our shares outstanding by 12.50%. Now, simply applying what we talked about before, if shares outstanding declined by 12.50%, then we already know that our price to earnings will also decline by 12.50%. Okay? Now, we can also calculate the changes in EPS. So going back, doing the same calculation, so we're taking our earnings or net income, dividing it by the new shares outstanding, which is 8.75. That gives us an EPS of 3.43 relative to the initial $3 a share, $3. Our price to earnings falls by 12.50%, and so our new PE is 9.33, and our dividend payout ratio falls by a significant margin, 4.17%. So really, when a company conducts a massive buyback program, there are clear, tangible benefits that can be reported on the balance sheet. Now, some people will call this financial engineering. It depends on how you view it. From a real, tangible benefit perspective, we'll look at the dividend payout ratio. That's a significant decline. That means that next year, we're going to have to pay $1.25 million less to our shareholders if you are a dividend payer. And so even for owners, so pre-buyback, we own 10% of the company, but post-buyback, our ownership percentage increased by 1.43%, a significant amount when you're accounting for a $320 million company. So that entrenches our ownership and it increases our interest to align with that of the remaining shareholders. So there are clear benefits that can be reported from a financial perspective. So let's summarize what a buyback can do. It reduces the price to earnings by the same percentage reduction in shares outstanding. It increases earning per share by an even larger percentage than the share count reduction. If the company is a dividend payer, the dividend payout ratio declines, and it increases the ownership percentage of remaining shareholders, thereby concentrating holdings. So what does this translate into? The increase in earnings per share and the price to earnings ratio usually results in a higher share price. For a lot of the more fundamental and simple retail investors, one of the clear ratios that they follow, metrics that they follow, is the price to earnings ratio, the earnings per share ratio. And especially for, maybe automated trading bots that, analyze different universe of stocks based on, a clear benchmark for price to earnings. And so with PE falling, the price that you're paying for the earnings of that company, for that $1, declines, and therefore you can buy that $1 in earnings at a cheaper price, which is a benefit. And that, if the company wants to value that company at the average PE ratio, means that it creates value because the share price has to readjust. It has to revalue to a higher level in order to account for that drop in the price to earnings ratio. A lower payout ratio increases the likelihood of future dividend increases. So say, for example, you're a company that, the board has set a maximum dividend payout ratio of 35%. You conduct a stock buyback program, which reduces the dividend payout ratio to 30%. Now, on a dollar for dollar basis, you can increase your dividend once again to reach that 35% payout ratio again, based on the lower number of shares outstanding. And with more concentrated ownership, the share price volatility also declines. Now, that's not a clear benefit, but in some certain cases, especially with smaller companies, that can be a benefit. Okay? So let's talk about the mechanics of the buyback. Let's talk about that rule, the SEC 10B Section 18 rule. Now, this is a SEC rule that provides a safe harbor for companies and their affiliated purchasers when the company repurchases shares of common stock. The repurchases will fall within 4 conditions. And essentially, one of the things that I always hear about from kind of people who talk about, share buybacks are bad, is they're always just like, they're manipulating the price, because they're creating this false buying demand within the market, which pushes up the value of the stock. That's not true. This rule clearly states, and we're going to look at the 4 conditions, that this company, in order to buy back that stock from the market, they have to follow these 4 conditions. So condition number 1, with regards to volume, the issuer cannot purchase more than 25% of the average daily volume. So they can't make up more than 25% of the amount of shares outstanding, amount of shares bought on the market for one day. Right? So you're talking about creating false demand. Well, they're making up only a quarter of the demand for that respective day. Really, to really push up a price, maybe they'll have to exceed that, right? Maybe go up to like 50, 60% of buying demand on top of the existing demand in the market to really push up the stock. So that's really reduces the amount of shares traded on a day-to-day basis. From a price perspective, the issuer must repurchase at a price not exceeding the highest independent bid. So they can't buy on an uptick. So essentially, you talk about, oh, well, that creates buying demand, which pushes up the stock. Well, in a scenario where there's increased buying demand, the ask price would increase, right? But the company is not allowed to buy on a higher ask price than the independent bid. So if independent bidders, independent buyers are not willing to buy at that respective price, then the company is unable to purchase at that higher price. And so that avoids and reduces the possibility of such price manipulation. In addition, from a timing perspective, with companies below a market cap of 150 million, they can't trade within the last 30 minutes, and for a market cap above that, they can't trade in the last 10 minutes. And also the manner of the purchase. The issuer must purchase all shares from a single broker. Okay? So now let's talk about, are stock buybacks bad for shareholders? So while corporate America has viewed share buybacks as a viable option, there are some investors who vote aggressively against them. So let's look at this group's main argument. Management has a self-interest to pursue buybacks. Buybacks manipulate prices due to a lack of investor knowledge. The cash used in buybacks is lost and no tangible benefits are realized. And until the company is sold, the cash used is unrealized and at risk. So these are 4 common arguments against buybacks. So let me respond to each of them and kind of offer my opinion. And once again, this is my opinion. At the end of the day, there is no right or wrong. It's all dependent on the certain scenario that you're looking at for respective companies. There are certain companies that should not be pursuing a stock buyback program, and there are companies that should be. Right? So let's talk about one. Management prefers buybacks because of their compensation packages. Many CEOs in corporate America are compensated based on achieving certain financial performance benchmarks. One of the most common measures is EPS. And with stock buybacks, management has full discretion to inflate EPS simply by reducing the shares outstanding to personally benefit from the capital allocation. First off, it's completely true. This is a very good argument. For a lot of companies, especially the larger conglomerates, where it's much harder to attain EPS growth from an organic perspective, the company usually pursues acquisitions. And if acquisitions is not available, if there are no real kind of strategic plays, what happens is that management, in order to kind of meet these expectations that the board sets on a year-to-year basis, needs to inflate the price to earnings and hopefully reduce price to earnings and increase earnings per share, right? And one of the easy ways to do that is to conduct a stock buyback. So this is a very true, argument. At the same time, you have to realize that it's only one side of the story. If the management conducts that buyback during a time where shares are undervalued, and we'll talk about this later, then that can create longer term value. So you have to really take everything and look at it from a whole. So number 1 is good. What about number 2? Buybacks are a form of price manipulation due to incomplete information. So we talked about on the day-to-day trading and how the SEC ruling avoids that and prevents that from occurring. But what about on a longer-term perspective, maybe from a medium-term perspective? Well, this assumption, essentially it assumes that because the company is reducing the amount of shares outstanding, the existing buying demand within the market assumes that there's a limited supply and therefore pushes up the price, pushes up higher and higher and higher without any real change in the company. The thing is, the market is incredibly efficient. Whether it is M&A or buybacks or any corporate move, the company's share price has frequently proved its ability to predict value creation and destruction. And if anyone knows the efficient market hypothesis, all information is priced into the stock price. And especially for big multinational companies like McDonald's or General Electric or Procter & Gamble, you're not going to see that incomplete information reflected in the stock price. Like millions, billions of dollars are flowing through that stock. Institutional investors who are incredibly sophisticated and understand buybacks are investing in that stock. And so when you're really referring to price manipulation due to incomplete information, that's only relevant for the smallest of companies that are conducting buybacks. But the most backlash originates from the biggest companies who, of course, conduct the largest buyback programs. And that doesn't make sense. So if a stock is reacting negatively to a buyback announcement, it usually isn't. and usually it actually reacts positively. And assuming the efficient market hypothesis, then that means that the market is responding positively and is anticipating that that buyback will create future value, and that's why the stock price is increasing. And so I really disagree with this. I don't think that this is a relevant argument, especially with the larger corporations, because you have millions of investors who are looking at the same company, and the likelihood of that incomplete information really taking hold of the stock is very unlikely. So number 3, the cash used in buybacks is lost and no tangible benefits are realized. This depends. So essentially what this means is that from a purely dollar perspective, you're taking that money and you're going to the market and you're buying shares on the market. And of course, people who want to sell those shares are going to receive that cash. But the investors who really own that cash don't get it. They don't get that cash, and they have no say in it either. And it really depends on your perspective. As a shareholder, it's true. You do not receive any cash from a buyback. This move and the buybacks are usually more focused on the business itself because it helps reduce the price to earnings ratio, which leads to a potential revaluation as the market continues to reward the business with further growth. In addition, from a net asset value perspective, the NAV per share increases as the shares outstanding decrease, thus improving the underlying value of the business. And so this is probably my core argument, my core rebuttal to anyone who really wants to talk about how stock buybacks for big companies are bad. From a net asset value perspective, if the company is buying below the net asset value, paying less than that, then any stock buyback is great. Because what happens is that nothing changes from an asset perspective, right? You still have those core tangible assets. And so you're spreading out the value of those assets with fewer people because you're reducing the amount of shares. And therefore, you're creating that value that's attributable to existing shareholders, remaining shareholders. So from that perspective, from a purely, net asset value perspective, if you buy below the NAV, you're creating value for shareholders and stock buybacks are good. But that's a very important condition. Okay? And then number 4, until the company is sold, the cash is unrealized and at risk. And this ties into the third kind of argument and the whole valuation in the net asset value of the business. In a way, stock buybacks can be used as a long-term call option. And this is what a lot of people say. Oh, it's a long-term call option and we don't realize those benefits right away. Well, it is a long-term call option, but again, from a short-term perspective, you have the price to earnings, which falls. You have EPS, which increases. Nothing changes from an earnings perspective. That's fair. But remember, you have a business that has tangible assets that are reported on that balance sheet. And if you're spreading out those assets to fewer people, if you're dividing the value of that asset to fewer people, then from a net asset value perspective, you're benefiting. Okay, and that's really important. Okay, so now let's take a look at the difference and really kind of compare dividends versus share buybacks. And so to judge whether dividends or buybacks are better, it is important to understand what a dividend communicates to shareholders. And this is so important. Most investors would likely view a dividend as being a positive signal that says the company in question is confident in the future sustainability of its business and expects positive results going forward, allowing the dividend to be maintained. This means that the company expects to maintain this dividend in cyclical highs and lows. And so the reason why the board is always so averse to cutting the dividend, and the reason why a lot of companies are fearful of that, is that because it's an underlying signal. The market interprets a issued dividend or an increasing dividend as strength in underlying operations, the assumption that the company is making a future commitment to paying out and meeting this obligation regardless of the business cycle, regardless of whether it's at the top or the bottom. And that means with an increasing dividend, the underlying strength, the core strength of that business is increasing. And that's why, when we talk about the dividend valuation model, that was what the core was. It took that signal and attempted to draw a valuation number from that dividend. Now, of course, there are more sophisticated valuation methodologies now, but the theory behind it is very, very important. And that's why when you look at dividends and you look at the amount of money that a company commits to paying out in the future, it's important that the company is confident in meeting those obligations. And don't even get me started on special dividends. Rather than taking that extra cash and just throwing it out at a one-time dividend, that does nothing. what you really want to do is if you're thinking about capital allocation and you're choosing between share buybacks and dividends, if you feel that the cash that you have on hand right now, you won't earn in the future, then it doesn't make sense to increase your dividend by a significant margin to really pay out this cash. Use it for buybacks, maybe increasing it by a little bit amount, the dividend. But at the same time, you want to make sure that you're communicating a signal of sustainability, not of a cyclical high or low. And that's why, when a lot of people say, take all that extra cash and pay a dividend or increase the dividend by a big amount, that doesn't make sense, because that's an unhealthy signal. Because then investors are going to question, can you really meet that dividend during a recession? And what will end up happening is it'll be like General Electric, where General Electric cut their dividend during the financial crisis and everyone lost it, right? And it really hurt investors' trust in the company. So on the other hand, a buyback is often viewed as a signal that management believes their shares are undervalued. For larger companies, that also means that the growth opportunities are much more limited and EPS expansion is the shorter term option. So there is no doubt that a lot of companies benefit from the appearance that EPS has grown in the short term to help them benefit shorter term investors and management dependent on share price performance goals. So we talked about that. So it's clear that short term speculators and management who get paid and compensated based on achieving certain financial targets benefit from share buybacks. But at the same time, in what I was communicating before and what I want to reiterate is that if management is buying shares back at below net asset value per share, then that's creating tangible value that shareholders will benefit from. Okay? So the important question is when these repurchases are done. If the company buys at a cyclical high, it will probably destroy longer-term shareholder value for the shorter-term gain. However, if the company buys at a low when shares are significantly undervalued, the reduction in outstanding shares significantly impacts future EPS performance and results in a lower payout ratio and higher dividend increases in the future. Now, what does undervalued mean? Don't focus on the net present value of cash flows, but rather the net asset value of the business. If a business's assets are undervalued due to market sentiment, reducing shares outstanding offsets the outflow of cash and increases net present value per share. So essentially, what this slide is trying to get at is that a lot of students and analysts, they conduct a discounted cash flow model, right? And so they conduct a net present value of future cash flows. Now that's dependent on the discount rate. That's dependent on actual tangible growth in earnings. But from a net asset value perspective, you're just looking at the market value, the net asset value of the company, right? So the difference between the market value of its total assets and its market value of its liabilities, right? And so in a liquidation scenario, which you don't want to assume that, but at the same time, if you were to look at it just from a pure valuation perspective, if you are buying below the net asset value, then the amount of shares, that reduction significantly increases the net asset value. So let's take a look at just a numerical example. So here we have a company with assets of $15 million, liabilities of $2.5 million, and cash used for the buyback of $750,000. Now it's important, some people always are like, oh, well, cash is part of assets, right? So if you use cash, then the net asset value decreases. Well, we account for that. Even accounting for that subtraction of, the current asset of the cash from the asset side of the balance sheet, we get a net asset value of $11,750,000. Okay? We then divide that by the shares outstanding of 1 million. So that's pre-buyback. And that will give us a net asset value of $11.75. Now, at a current share price of $8, if management were to buy at this price, they're buying below the net asset value and therefore creating value. So they take that $750,000 and they divide it by 8 to retire 93,750 shares outstanding. So the new shares outstanding is 906,250 shares. Okay, so from the original 1 million shares, it's now 906,250 shares. Now, if you were to divide this net asset value, because nothing has changed from the net asset value perspective, if you divide that by the number of shares outstanding, you will get a net asset value of 12.97. And that increases the net asset value simply by buying back shares by 10.34%. So that's a tangible benefit to all remaining shareholders. And that's really that's really the key. At the end of the day, if you want to take something away from this video, what's important is that you're buying shares back at below net asset value, and therefore you're creating tangible benefit for shareholders. And so here's a simple illustration of the S&P buybacks versus the S&P dividends. As you can see, the signal, we talked about that signaling that occurs with the dividends. The signaling is much more stable. It's much more consistent in nature, whereas with buybacks, they're incredibly volatile. And unfortunately, many businesses ignore this important distinction between net asset value and net present value. During cyclical highs, when expectations are unrealistic, the net present value of a business may seem higher than its current share price, and thus many managers and executives fall into this, I'm going to buy back shares now because I assume that, the net present value of future cash flows is very high, and therefore it's higher than the current share price. But if they look at the net asset value, it's actually lower than the current share price, and therefore they're destroying value. So you really need to make that important distinction, and if you do that, then you will create value through buybacks. Other than that, that's pretty much it. As always, if you did like this video, please comment and like and subscribe to the channel for more. If you have any questions, comment below. And as always, check out other videos. I have some videos on IPOs, investment banking interview questions, DCF modeling, and other valuation methodologies. So there's a bunch of stuff on my channel which you probably like. Thank you guys so much, and have a nice day.